again and giving you another
Thank you.
perspective. So here we go. Okay. Now company, they need, for example, $2 million loan. And how many bonds they need to issue? Because one bond value 1,000. So they need to issue 2,000 bonds, units of bond, right? So this is January 2016. So on which rate company should issue the bond? Companies look at the market rate. The banks are providing at 10%. So I'm going to also provide coupon at 10%. And this is for 5 years. Now, company cannot change this interest rate between 5 years. So it means 1, 2, 3, 4, 5, company will pay 10%, 10%, 10%, 10%, 10%. But do you think that the market rate going to be stay the same?
No, it's different.
The market can be year 1 can be 10%, year 2 can be 15%, year 3 can be 17%, can be again 12%, and can be 8%. Right? So market we don't know, because it fluctuates with interest rate can be determined through number of other factors as well. Government policies, fiscal policies, right? The central bank intervention. It's like that. If there is more, inflation, then what happened? The central bank intervened to try to control the inflation. They, decrease in, interest rate or whatsoever. So they do some kind of like monetary policy. This is the pure economic stuff and finance stuff over there. So, but we know that the market rate is variable. But when you issued the share, you promised that you would pay 10% throughout the year. So due to that differences, the market price of the bond changes. So you can take this picture and we can continue this example because I don't have much space here. So I need to erase one more time. So first year, 10%, second year, 15%, just giving you the rough idea here. So when you issued the bond, market rate was 10%, and you also make your coupon rate 10%. So for investors, those who want to save their money, for them it is indifferent whether they place their money to the market, to the bank, they receive 10%. Whether they place their money to you, they also receive 10%. So bond value would be traded at par, which means $1,000. Or in the market, it is quoted as 100 quote. Right, guys? Now, if the market rate after some time increased to 15%, what the investors they think. And coupon also increased to 10 to 15%? No. Coupon will remain 10% throughout its maturity life, 5 years. Now, the investors say that we are losing our money. We should take out our money from this company and invest in this bank rate or market rate to get this 15% because we want higher return. We want to increase our wealth. What happened to the price of the bond? Price of the bond decreased. Why? Because demand of the bond decreases. So in stock exchange, prices are determined by the forces of demand and supply, right? So people buy that security which gives them higher return. So they don't want to buy that security which pay them lower return. So they sell, or the new investor, they don't want to buy the company's bond, or those who already have the company's bond, they will sell the company bond and buy the security which is giving them higher interest rate. So when price decreased, it is quoted below, or the value is $887. The quoted rate is 88.75. So it means the value is below the par, below 1000. We call this right now, the investor or the stock market will call that the bond is now selling at discount. Sipade, understand? Misha, understand? Minsu, Pingping, Junpyo, Chloe, Arone, understand this?
And what if it's the other way around? Is it a premium?
Yes, we'll talk about that. So when the market rate is greater than the coupon rate, price of the bond falls and it would be selling at discount, right? Now the other way around. What if the market interest rate is now decreased to 8%? What will happen? Company issued bond at 10%, while in the market the rate is 8%. What will happen? Many investors they will take their money out from the market, from the bank, and they invest in coupon rate. So demand of the company bond increase or decrease? Because company is giving you higher return, so demand for the company's product, which is company's bond, increases. When demand increases, its price increases. It would be quoted at, this is just a rough number, it can be 1.3, can be 1.9, whatsoever, right? But it would be treated above the par. Let's just talk about this here. So above par, which is 1000, it means now the market will say that the bond is selling at premium. Right, guys? Misha, Sipade, Min, Arone, understand?
Yeah, makes sense. Okay.
Right? So this is the hardest part here. If you understand that one, you can easily make the entries, accounting entries and all those stuff. It is very easy for you if you understand this concept. So our all the future discussion regarding the treatment of accounting treatment for bond depends on this concept. Right, guys? Sipade, you understand? Min, Chloe, Junpyo, Minsu, Pinkman, right?
Sir, could you just explain the difference? Not with this I understand, but the principal and face value and par value. What's the difference again?
Par value and
Principal, par value, and face value.
same.
Oh, principal and face value same.
Okay. These are, we can call them with different names. So this is the bond, for example, bond, and the bond, and this is 1 unit. So one certificate of bond value 1,000. We have different names. We call this par value. We call this principal value. We call that maturity value. And we also call this face value. So this is the different names of the same, but concept is the same, right? Misha? Par value, principal value, maturity value, face value is the name of the value of the bond written on the face of the bond, not the market value. Market value can be different, can be above the face value or can be below the face. That is the market value, right? So let's go back to our slides and let's talk about this. So here we go. Now, when I read this slide, so it started making sense. Bonds always sold at market price, right? If companies sold the bond, it would also, or company issue the bond, it will always issue the bond at market price. And market price can be par, can be premium, can be discount. Okay? So there are two interest rates that sets the bond price. One is called the stated interest rate. We also call this coupon. And one is called the market interest rate. There are different names of this market interest rate. Effective interest rate, bank rate, yield to maturity, whatsoever. Just include that as a market rate. So coupon rate, it is printed on the bond on bond certificate. So it determines the cash interest paid to the bondholders. While the market interest rate, it is demanded by the investors for loaning the money, plus it varies by minutes. So throughout the life of the bond, the coupon rate stays the same. So that's why we call this stated interest rate. Right? Here we go. Now you tell me. Assume that the stated interest rate is 8%. What does it mean? The coupon rate is 8%. So what should be the value of the bond? It means bond would be selling at discount, premium or par. So market rate is 6